Dividend ETFs come in all forms, and it's important to consider which works for you, from investing in dividend growth ETFs to exploring the growth of Dividend Aristocrats. Today, we'll explore the top 5 dividend ETF investment strategies that can help you achieve long-term growth and conform to your values. And with all that aside, coming in at number 1, we have Dividend Aristocrats. These are a select group of companies that have a long history of not only paying dividends to their shareholders, but also consistently increasing their dividend payouts each year. These companies are typically well established, financially stable, and have a strong track record of weathering economic downturns. The concept of Dividend Aristocrats is particularly interesting for investors seeking long-term growth and a steady stream of income. Investing in Dividend Aristocrat ETFs can be an excellent strategy for long-term growth. These ETFs provide investors with a diversified portfolio of Dividend Aristocrats, allowing them to spread their risk while still enjoying the benefits of dividend growth. Some of the key benefits of investing in these ETFs include consistent dividend growth. As mentioned earlier, Dividend Aristocrats have a history of increasing their dividend payouts each year, which can provide investors with a growing stream of income over time. With this in mind, Dividend Aristocrats typically have lower volatility, as they're well-established companies with stable earnings and strong fundamentals. This can lead to lower volatility in their stock prices compared to smaller, more speculative companies. As is most ETFs, by investing in a Dividend Aristocrats ETF, you gain exposure to a diversified portfolio of companies across various sectors. This can help reduce the risk associated with investing in individual stocks. And with that, guys, there are going to be several popular Dividend Aristocrat ETFs to consider, each with its own unique characteristics and historical performance. One of the ETFs, like the ProShares S&P 500 Dividend Aristocrats ETFs, or NOBL, tracks the performance of the S&P 500 Dividend Aristocrats Index, which includes companies that have increased their dividends for at least 25 consecutive years. Additionally, NOBL has a strong track record of weathering market turbulences over time by capturing most of the gains of rising markets and fewer of the losses in falling markets. Investing in Dividend Aristocrat ETFs can be a smart strategy for long-term growth, providing investors with consistent dividend growth, lower volatility, and diversification. With a variety of popular ETFs to choose from, investors can find the right option to suit their investment goals and risk tolerance.
I'm not fucking leaving!
And at number 2, we have high dividend yield ETFs. These funds focus on stocks of high dividend yields, providing investors with the potential for both capital appreciation and consistent dividend payouts. High dividend yield ETFs invest in stocks that pay higher than average dividends to their shareholders, attracting investors and those who are looking for strong streams of income. These funds typically track an index composed of dividend-paying companies, providing investors with a diversified portfolio of income-generating assets. By investing in high dividend yield ETFs, you can benefit from the potential for capital appreciation as well as the regular income provided by dividend payments. High dividend yield ETFs provide benefits and provide investors with exposure to a diverse range of companies, reducing the risk associated with investing in individual stocks. These high yield ETFs offer a steady stream of income through regular dividend payments, which can be particularly attractive for long-term investors seeking to grow their wealth over time. As well, high dividend yield ETFs can also provide capital appreciation, as the underlying stocks within the fund may increase in value over time. A popular high yield ETF, as a great example, would be the Vanguard High Dividend Yield ETF VYM. VYM tracks the performance of the STSE High Dividend Yield Index, which includes stocks of above average dividend yields. The fund has a 10-year annual return of 11.87% and a dividend yield of 3.1%. High dividend yield ETFs offer a compelling investment opportunity for those seeking long-term growth and a steady stream of income. By investing in these funds, investors can benefit from diversification, income generation, and the potential for capital appreciation. Popular high dividend yield ETFs such as VYM have demonstrated strong historical performance and include a diverse range of companies with a track record of consistent dividend growth. This ultimately puts high yield dividend ETFs at number 2.
Why did you stop? I said hit me. You flinched. Well, of course I flinched. You were going to hit me.
At number 3, we have dividend growth ETFs. These funds focus on companies with a strong history of increasing their dividends, providing investors with the potential for capital appreciation and consistent dividend payouts. As the name suggests, dividend growth ETFs invest in companies with a strong track record of consistently increasing their dividend payouts over time. These funds typically track an index composed of dividend-paying companies, providing investors with a diversified portfolio of income-generating assets. And by investing in dividend growth ETFs, investors can benefit from the potential for capital appreciation as well as the regular income provided by dividend payments. Dividend growth ETFs provide a wide range of benefits. These funds offer a steady stream of income through regular dividend payments, which can be particularly attractive for long-term investors seeking to grow their wealth over time. And by investing in companies with a strong history of increasing their dividends, these funds can provide investors with a portfolio of stocks that have demonstrated consistent growth and financial stability. Lastly, dividend growth ETFs can also provide capital appreciation, as the underlying stocks within the fund may increase in value over time. One great example of a dividend growth ETF fund that's one of my favorites is the Schwab US Dividend Equity Volatility ETF SCHD. SCHD seeks to track the performance of the Dow Jones U.S. Dividend 100 Index, which includes high dividend-paying U.S. companies with a record of consistent dividend payments. The fund as well has a 10-year annualized return of 12.06% and a dividend yield of 3.3% currently. Dividend growth ETFs offer a compelling investment opportunity for those seeking long-term growth and a steady stream of income. By investing in these funds, investors can benefit from diversification, income generation, and the potential for capital appreciation while also focusing on companies with a strong history of dividend growth. Popular dividend growth ETFs such as SCHD have demonstrated strong historical performance and provide investors with exposure to a diverse range of companies with a track record of consistent dividend growth. This makes dividend growth ETFs the top 3 on the list.
With compounding interest, and it's gone.
At number 4, we have international dividend ETFs. Diversifying your portfolio with international dividend ETFs can offer several benefits, including reduced risk. International dividend ETFs can help to reduce overall portfolio risk by spreading your investments across multiple countries, sectors, and companies. This diversification can help to mitigate the impact of market downturns in any one region or industry. With this in mind, some international dividend ETFs offer higher dividend yields than their domestic counterparts, providing a potentially attractive source of income for investors. International dividend ETFs also expose you to a variety of currencies, which can help to reduce the risk associated with fluctuations in any single currency. Lastly, international dividend ETFs provide you exposure to global markets, allowing you to capitalize on growth opportunities in various regions and industries. With all these benefits aside, everything has its downsides. By investing in international dividend ETFs, you're prone to fluctuations in currency exchange rates that may negatively impact the value of your international investments, potentially offsetting any gains in the underlying securities. International markets can also be especially subject to political and economic instability, which can lead to increased volatility and potential losses for investors as well. Lastly, although some international markets may have lower trading volumes, making it more difficult to buy or sell shares of international dividend ETFs at desired prices. A popular international dividend ETF example would be the iShares International Select Dividend ETF (IDV). IDV tracks the performance of the Dow Jones EPAC Select Dividend Index, which includes high dividend yielding international stocks. The fund has a 10-year annualized return of 6.4% and a dividend yield of 5.2%. Diversifying your portfolio of international dividend ETFs can provide several benefits, including reduced risk, higher yields, currency diversification, and access to global growth. However, it is important to be aware of potential risks such as currency risk, political and economic risk, and liquidity risk. Overall, popular international dividend ETFs such as IDV offer different approaches to international dividend investing and have demonstrated strong historical performance, making it one of the top 4 on the list.
Grover, what is it? This has to be quick. I am so pressed.
Coming in last at number 5, we have low volatility dividend ETFs. These funds focus on stocks of low volatility and a history of paying consistent dividends, providing investors with the potential for capital appreciation and regular dividend payouts. These low volatility dividend ETFs invest in companies with a history of stable earnings and low price volatility, which can help to reduce the overall risk of your portfolio. Additionally, these funds target companies that have consistently paid dividends, providing investors with a reliable source of income. By investing in low volatility dividend ETFs, investors can benefit from the potential for capital appreciation and a steady stream of income. By investing in low volatility dividend ETFs, it can provide investors with exposure to a diverse range of companies, reducing the risk associated with investing in individual stocks. Low volatility dividend ETFs can also provide capital appreciation, as the underlying stocks within the fund may increase in value over time. Most importantly, by investing in companies with low volatility, these funds can help to reduce the overall risk of your portfolio and provide more stable returns over the long term. A perfect example and a popular choice among many for low volatility dividend ETFs is the Invesco S&P 500 High Dividend Low Volatility ETF. SPHD tracks the performance of the S&P 500 Low Volatility High Dividend Index, which includes 50 high dividend yielding stocks of low volatility. The fund currently has a 10-year annualized return of 9.63% and a dividend yield of 4%. In conclusion, low volatility dividend ETFs offer a compelling investment opportunity for those seeking long-term growth and a steady stream of income. By investing in these funds, investors can benefit from income generation and the potential for capital appreciation, all while focusing on companies of low volatility and a history of paying consistent dividends. Today, we went over the top 5 dividend ETF investment strategies for long-term growth. If you guys learned anything or you took in anything from this video, please like and subscribe. I'm going to be posting some more bangers. I'm putting a lot of effort into these videos. As you can see, the videos are getting longer, they're getting better. Everything's gonna get a lot better, and I got some more stories coming up. I know you guys will like the VYM, that the video I made. It actually reached 72 views recently, so I'm very proud of that video, and it's performed very greatly. But yeah, I just wanted to say a little bit of that, guys. Make sure you guys tune into my other videos, and I'll catch you guys in the next video. Thank you.